Hi everyone, welcome back to Financial Futures, where we keep you updated on all things finance, from the markets to the policies shaping your wallet. Today, we're diving into a big question: what's next for interest rates? Next week, the Federal Reserve will meet to decide on interest rates, right after the recent election. Wall Street's buzzing with predictions, expecting a rate cut. But inflation reports and economic data suggest things might be more complicated. Let's break it all down. Just yesterday, we got a fresh look at inflation through the Core Personal Consumption Expenditures Index, or Core PC. Unlike the Consumer Price Index (CPI), which tracks what we pay for items directly, the Core PC gives the Fed a broader view of costs, including things paid on behalf of consumers, like employer-paid health insurance. Core PC inflation rose by 2.7% over the last year, slightly above Wall Street's expectation of 2.6%. Although it may not seem like a huge increase, this matters to the Fed. Their target is 2% inflation, so we're above that line. Why does this slight uptick matter? It's because this inflation number is stacking on top of the inflation we saw in 2023, 2022, and 2021. That kind of sustained inflation can lead to fewer affordable products, tighter budgets, and ultimately financial strain on everyday people. Next up is economic growth. According to the latest GDP report, the U.S. economy grew at an annualized rate of 2.8% in Q3 2024, higher than many anticipated. Typically, when the economy is growing this fast, the Fed might hold back on rate cuts to avoid overheating things. On Wall Street, this growth brought a wave of optimism. The stock market has been on fire, with major indices like the Dow, Nasdaq, and S&P 500 hitting record highs. But while this sounds like great news, it's not a straightforward win for everyone. Investors are excited, sure, but rising stocks and economic growth may not translate to immediate benefits for everyone, especially if inflation keeps up or interest rates start to climb. Another key player in this story is the job market, and here, the news is mixed. On the one hand, layoffs fell to a 3-month low in October. However, new data also shows that more people are staying on unemployment longer than before. This could suggest employers are in a holding pattern, waiting to see how interest rates and policy changes post-election shake out. Interestingly, some companies are adjusting their strategies based on future market expectations. They may be pausing hiring or even adjusting payrolls based on their industry's unique circumstances, from tariffs to changing demand. This kind of cautious approach means they're waiting for clarity, which might not come until next week's Federal Reserve meeting. Now let's talk about housing. Even as the Fed has hinted at possible rate cuts, mortgage rates have been climbing. You might wonder why, and here's the reason: the 10-year Treasury yield has been rising, which is closely tied to mortgage rates. Higher yields mean higher rates for new home buyers, and this is eroding purchasing power. According to Redfin, buyers have lost around $33,000 in purchasing power just in the last 6 weeks. For context, a buyer who could afford a $475,000 home in September may now only be able to buy a $442,000 home. So, this shift impacts people planning to buy and anyone relying on real estate for investments. This Fed meeting is unique because it's happening right after the election. While the Federal Reserve is technically independent, the chairman's role can be influenced by the White House, as the president has the power to appoint or remove the chairman. So, some believe the Fed's decisions could have a political angle, potentially favoring cuts under one administration or holding steady under another. This adds a layer of complexity to what would otherwise be a purely economic decision. The Fed faces pressure from those hoping for rate cuts to stimulate the economy, while others argue that cutting rates now could worsen inflation. Both sides have valid points, making it an interesting decision to watch. So, should the Fed cut rates? Lower interest rates make borrowing cheaper, which can be great for businesses and consumers wanting to buy on credit. But here's the flip side: the U.S. economy already has about $35 trillion in national debt, and adding more could inflate the debt bubble even more. Some say the U.S. economy is robust enough to handle this, given its global strength. Others worry about a tipping point that could lead to economic instability if we keep accumulating debt and pushing inflation higher. And these are valid concerns that the Fed has to consider carefully. Here's where we are: the Fed has a choice to make, and it's not an easy one. Lower rates could stimulate the economy and the stock market, while higher rates might help curb inflation and benefit cash savers. The reports we've seen on inflation and GDP growth will play a role in this decision, as the Fed weighs whether our economy needs a little help or a little cooling off. What do you think the Fed should do? Let us know in the comments below, and if you found this breakdown helpful, make sure to hit that like button and subscribe to Financial Futures for more insights into the economy, Social Security updates, and the policies that impact your financial future.